Hello traders, Gary Wagner here. Approximately 12:30 in Honolulu, 6:30 in New York on Friday. Happy Aloha Friday, as we say on the islands. It is the 13th day of August, 2021, and this is the daily report for gold and silver, our weekend review, and this is a special report. We are picking up where we left off our discussion throughout the week, which is that we are in a corrective bounce to the upside, and we will go into much more detail looking at different time cycles and trying to explain some of the nuances of Elliott wave theory. I hope you enjoy the show. All week, we have been talking about an Elliott wave count that is bearish using daily charts. Although using this time frame, gold's count may be bearish. With the fractal nature of wave theory, the count will be different on other time cycles. On today's video report, we will look at multiple time frames to demonstrate the fractal nature of the Elliott wave principle. We will also discuss that even though we are currently in a bearish count, we are currently in the corrective phase of that count, which means that we are expecting to see a continued rise in the price of gold. One of the basic tenets of Elliott wave theory is that market structure is fractal in character. The non-scientific explanation of this fractal character is that the Elliott wave patterns that show up in long-term charts are identical to and will show up on short-term charts with sometimes more complex structures. This is the property of fractals, and it is also called self-similarity or self-affinity. This first chart is a daily candlestick chart, and it does have a current Elliott wave count. This is a chart we have been looking at all week, a completion of a fifth wave, and then went into a corrective phase, A, B, and then a C. But then it did convert into a bearish count because if you notice, we get another A, although this A moves up, meaning it's a counter wave, and then our B wave moving down, the opposite of what we would expect to see on a bull count, and this long C wave taking us up to 1920. And as you can see, this C is going in the opposite direction of the other C, showing us that we have now gone into a bear count. This is a current Elliott wave count using a weekly chart, and it moves it up one level. The key distinction when we look at this chart is it is still fully immersed in a bullish count. We have our wave 2, which began in July of 2018 when gold was trading at 1168, up to a major third wave. You've got 3 major, intermediate, and minor, down to a fourth wave. And then we've basically done a calculation, which is to times the length of wave 3 and begin an extension from the conclusion of wave 4, which is where we get our numbers long term that we could see gold move to 2236. And again, that's a long-term time frame, but we can move out even further than that. And using a monthly moves us up the scale in terms of cycles. I've just put up the legend to the different types of cycles and the time span that they incorporate. But what we're looking at here with the monthly is that we began our wave 3 in 2001. Gold was trading at $200 up to the first record high at 1920 in the middle of 2011, down to the lows that occurred at the end of 2015, beginning of 2016, just above 1,000. And it also shows that we have completed our fifth wave on our monthly chart and are now in some sort of an A, B, C. While this has been an oversimplification, the idea of this video was to show you that by using different time sequences, we get completely different readings and we get outlooks that are very, very short term to extremely long term in nature. This has been Gary Wagner wishing you, as always, good trading. Have a great weekend. We'll talk to you on Monday for the next daily update and review. Bye-bye.